So they're still trying to figure out what it is.
Yeah.
Like they haven't figured out it's a macro asset. Others have. The sovereign wealth funds obviously are just doing it for diversification of reserves. They're like, it's a technology, it's a diversification of reserves. So if the US is going to do it, we're going to do it. So there's different groups doing different stuff. There is a bunch of people who still don't really want to do the homework on it. They're like, we don't know, it's too volatile for us. But I think usually it's the first mover advantage in this. You know, what people like to do, because there's so many new participants in the industry, they think it's all new and different. When you've been around as long as you and I, you realize nothing is different. We've gone through all of this before. This just happens to be a bigger, faster moving asset, but it's the same as GSCI was. It's the same as the gold ETF was. You know, it's the same as the NASDAQ was when we didn't understand what it was and why it went up all the time. It's all of these things combined, right?
The global economy is quietly setting the stage for something big, not a collapse, but a surge that could rival the greatest bull markets in history. According to macro investor Raoul, we may be entering what he calls the perfect storm for risk assets. It's a convergence of falling inflation, easing central bank policies, and a softening in global tensions, all while most investors remain on the sidelines. Powell points to the powerful role of liquidity. With money beginning to seep back into the system and rate cuts looming on the horizon, the conditions are forming for what he calls a melt-up scenario, a rapid, emotionally driven rally in both equities and crypto. And this time, it won't be about strong earnings or economic data. It'll be all about positioning, momentum, and the fear of missing out. As recession calls fade and volatility dries up, investors could be caught off guard. The risk isn't a downturn, it's being unprepared for an explosive upside. Please remember to like this video, subscribe to the channel, and enable post notifications before we delve further. Thank you, and enjoy the video.
It feels that way to me, and I think you're right. There is a risk here that we rerun 98, 99 or 99 because you've just taken all the tail risk. Let's assume that Saudi, the US, and Israel do a deal with Iran. That feels like it's going to happen. Let's say that there will be a ceasefire in Ukraine, and let's assume that the Chinese will come to the table, do something reasonable. Those three things happen. We've taken all of the left tail off the table. And people are going to be like, oh, but inflation's going to come back. And they're going to keep saying that for 18 months, which they kept saying as inflation's fall. So I think it is not a small probability that we have a really blow off kind of next 9 months or so. The last Trump cycle in 2017, we had the same thing. The market corrected in the beginning because everyone's fearing tariffs and the same narrative. The Fed were raising rates and doing the balance sheet runoff. And the market screamed higher all year because the Chinese were stimulating, the Europeans had to stimulate. So it feels like, you know, even if the Fed don't do anything, I still think the Fed cut, but let's assume they don't. Well, that's not a prerequisite for the market to do anything. As you said, as long as rates aren't jacking higher, everything's fine. And it took a long time for people to believe that. They thought it's something different, it's something unique. It's a macro asset. So you apply the same things that I've always used, which is liquidity, business cycle, all that stuff, plus a bit of technicals and sentiment. There's no voodoo here. It's pretty straightforward as an asset. It's just more volatile. So it's harder to deal with. But you were right. What I was seeing was like the liquidity indicators like Global M2 had stabilized and started going up. It leads Bitcoin. Bitcoin was following it almost perfectly. So I was starting to look for the bottom. Then I start looking at stuff like, okay, where's sentiment on NASDAQ? Because it's tech stock, same thing. It was in the gutter.
Right.
You know, sentiment was the worst I had seen since COVID. And that was across the board, across everything. You know, even hedge fund long short, everybody was max bearish. And I'm looking at liquidity. It's going up. I'm seeing the market getting fearful over a narrative. And I'm like, well, what is the likely outcome here? Are they going to have 150%, a trillion percent tariffs on China? No, they're going to reach something normal. So you've gone from peak headline fear to things could only be better from here. So for me, it was like a no-brainer of an opportunity, both in tech stocks and in crypto. And so going forwards now, normally speaking, this is the period, my framework is about, you know, them rolling the debt and having to provide liquidity to do so. And so what we've got is a lot of forward-looking liquidity coming out of whether it's the weakness of the dollar, whether it's other countries using their balance sheets, a number of different mechanisms. And all of that to me is suggesting that the rest of this year is going to be very strong. And I was kind of thinking the NASDAQ was going to be a V-shaped recovery. And my God, it was a V-shaped recovery. And people are still underweight and short. I mean, it's a hell of a setup. We overlaid the chart of 1997, the Asian crisis, which was a short, sharp shock, versus now it's almost identical. The kind of the 4-month period leading up to it, 4 or 5 months leading up to it. And that was a V-shaped recovery as well, because everybody was caught off sides because they thought the world was going to end. Liquidity came into the system. It was via the Fed that time cutting rates and all the other central banks. And the market just went up in a straight line for the next 2 years.
Raoul Pal is examining a totally different picture, one based on actual macro statistics and how money moves through the economy, even though the majority of headlines still center on concerns about inflation and international tensions. He asserts that cryptocurrency is not a niche market. The same factors that move stocks also move it: investor mood, liquidity, and the overall business cycle. However, despite a quiet recovery in pricing, investor sentiment in stocks and technology is still very pessimistic. Retail traders, institutions, and hedge funds have largely remained passive, underexposed to stocks and cryptocurrency. Raoul believes that the combination of rising prices, growing liquidity, and low expectations is a quintessential contrarian situation. He notes that global factors such as continuous debt rollovers, a declining value of the dollar, and moves by central banks elsewhere are driving this new surge of liquidity rather than the Fed directly. Together, these factors result in a covert increase in liquidity that supports markets without most investors even noticing. Don't forget to subscribe and hit the bell icon to stay updated on our latest videos. We'd love to hear your thoughts in the comments. Now let's dive back into the interview.
The institutions are still either trying to figure out what this thing is.
Yeah.
Right? I had a conversation with one of the biggest kind of financial asset management firms in the world yesterday, based out of the US. And they're like, they've even got a crypto division, but they're other kind of where they allocate the assets. They're like, we don't know how to deal with this. So they're still trying to figure out what it is.
Yeah.
Like they haven't figured out it's a macro asset. Others have. The sovereign wealth funds obviously are just doing it for diversification of reserves. They're like, it's a technology, it's a diversification of reserves. So if the US is going to do it, we're going to do it. So there's different groups doing different stuff. There is a bunch of people who still don't really want to do the homework on it. They're like, we don't know, it's too volatile for us. But I think usually it's the first mover advantage in this. And, you know, again, it reminds me a lot of back in the day when Goldman rolled out the GSCI index and nobody had commodities in their portfolios. And that team had to go around and sell commodities to everybody.
Right. Look, guys, it's backwardation. It works like this. You roll into a cheaper contract and you generate profit from that, right? Like
they would say, the clients would say, but it's too volatile. And you say, yes, but
right.
Part of a diversified portfolio, it's exactly the same thing, right?
That's right.
It's exactly. And also, you know, we were around when the gold ETF started and it's the same thing. Everyone was like, shit, where did this come from? It became a very, very big ETF. It's exactly the same. You know, what people like to do, because there's so many new participants in the industry, they think it's all new and different. When you've been around as long as you and I, you realize nothing is different. We've gone through all of this before. This just happens to be a bigger, faster moving asset, but it's the same as GSCI was. It's the same as the gold ETF was. You know, it's the same as the NASDAQ was when we didn't understand what it was and why it went up all the time. It's all of these things combined, right?
Totally brilliant, Raoul. Totally brilliant.
Right, the 3 big financial conditions thing. What we found is that leads like the ISM and other stuff by about 9 months. And it leads liquidity by about 6 months, something like that. Liquidity is what drives Bitcoin and NASDAQ, and it leads it by 3 months. So global M2, let's say, leads Bitcoin by about 3 months. I found out, I was like, what's going on with gold? I put it against against financial conditions. It reacts in real time to financial conditions.
Wow.
I'm like, holy shit, why didn't I figure this out before?
Of all trading securities, right?
Of all the things, well, because it's a pure currency asset, right? It's the pure thing. And so the moment financial conditions ease, gold moves. And so it's leading everything else. Which was, we were kind of thinking, is it leading or is it doing something weird? Is it trying to price in some catastrophic risk? No, it was just pricing in the fall in the dollar, the fall, rates didn't really fall a great deal, but the fall in oil.
Do you think that he's going to have a material effect on the price of Bitcoin, or is this a sideshow?
No, it's real. And I'll tell you why it's real. I've just come back from the Middle East. All of the sovereign wealth funds are now buying. Right, these are the largest pools of capital in the world. We're hearing it out of Saudi, out of Abu Dhabi, out of Qatar, and out of Bahrain. And why that's happening is because the US has become crypto friendly. It's the green light. So the US will get some regulation through. There'll be a bit of a shit show and debating about it and the usual stuff, but they will get some regulation through, which is the clarity that all of the pension funds need. So they're waiting as well. So there is a lot of buying to come from the really big players who've been waiting. Like Goldman has not been able to fully build out its desk, and JP Morgan haven't. They've had crypto for a while, but only for certain types of customers. But they want to build out suites of product, but they've been waiting for regulatory clarity. So, yeah, I think it's a big deal, actually. I really do.
Raoul Pal provides us with a strong takeaway. These organizations have desired to get more involved with cryptocurrency, but they were unable to do so in the absence of clear regulations. Now that is changing. The floodgates will open when regulation is finally implemented, even though it may take some time and include political back and forth. The interest is genuine and rapidly increasing, as seen by the diversification of sovereign wealth funds reserves and the ongoing efforts of asset managers to determine how cryptocurrency fits into their conventional frameworks. Raoul contrasts the current climate with previous pivotal moments in financial history, such as the introduction of commodities, gold exchange-traded funds, and even the Nasdaq, which were greeted with skepticism. Every time markets changed and early adopters were rewarded. Crypto, in his opinion, is the most recent chapter in that story. It is larger, faster, and still follows the same patterns. He also discusses what we might infer from the fact that gold is already moving. In contrast to other investments, gold responds immediately to shifts in the financial landscape, such as declining interest rates, oil prices, and a declining value of the dollar. Gold leads while other assets trail. This real-time response indicates that traditional currencies are facing pressure and that the system is changing. Gold and cryptocurrency become the escape route if governments continue to borrow and spend wildly, weakening their currencies. Don't forget to like, subscribe, and enable notifications for more valuable content, and as always, happy investing.